don't go with what's popular, go with what's aligned with your values. It shows that there are no shortcuts. Even if you're Don Valentine, there are no shortcuts. There's always big markets, great teams, differentiated technology, blah, 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 blah. That's motherhood and apple pie. That's totally meaningless.
Welcome to the Smart Venture Podcast. We're here to bring you the latest and greatest from the Silicon Valley, where unicorns roam and innovation never sleeps. We've got top investors, superstar founders, and well-known tech executives lined up to share their secrets on building and investing in successful companies. Just a quick disclaimer, while we may sound like financial geniuses, but please don't mistake us for your friendly neighborhood financial advisors. So let's get started and dive into the wild world of tech entrepreneurship. Hi, Jake. Thank you so much for coming to the show today.
Thanks for having me.
Awesome. So to start the show, I would love for the audience to get to know you a little bit more. So you've started your career as a PM at Cisco. Later, you joined Westpac and Grace Venture Partner as an associate. And later on, after the team split into Lightspeed Venture Partners and Alpes Capital, you went with the Lightspeed team. When you joined, you were an associate. And then when you left, you were a managing director there. Later, you started 10x.com, partnering with offline business to transform real estate companies into a digital company. And then you eventually sold the company to THD Partners. Later, you started Stonebridge Capital, as well as now you just started a new one, Ballistic Ventures. Before we start the show, I would love for the audience to learn from you on what are some critical moments in your career that shape you into who you are today.
Yeah, well, that's a great summary of a long journey. So thank you for that. I think for me, it was the first decision graduating from college. So, I went to MIT, I was an engineer, double E in CS. And, what I realized was that I was very passionate about how to use technology to have a big positive impact. And, I was very interested in not just the engineering side, but the business side. How do you get great technologies into the market? And everybody who comes to MIT to recruit people, they're looking for engineers. And I thought, well, given my excitement about how you take this to market, I don't want to be an engineer. I want to be on the business side of a technology company. And at least back in those days, that was pretty hard to find. And so I made this decision to take a leap and say, hey, there's all these great engineering jobs, kind of flooding at me. I'm going to just say no to all that and try to figure out how to get a more business or product oriented job as an engineering person. And, I felt like, okay, I'm kind of like leaping off a building because I don't know how this works. I don't know if anybody's going to hire me. Again, there was, a lot less kind of transparency in the job market back then. And I took that leap because that's what I was passionate about. And that's where my values led me. And, that leap paid off in, an incredible first experience at Cisco as a product line manager. And so that really shaped me, going forward of saying, okay, follow your values. And, if you follow your values, you'll feel very rewarded. You'll be willing to take big leaps. You'll be willing to take risk. And if things work or they fail, well, it doesn't matter if it fails because you'll feel very fulfilled living your values. And so that first kind of leap, taught me that, and I've applied that since.
Totally. Just out of curiosity, because venture right now, it's like a lot more popular career than maybe back then. So I'm curious, what does a lesson translate to today? Because of venture is such a popular career choice for everybody. I'm curious, how would you go about approaching a career today?
Yeah, I think the lesson translates, don't go with what's popular, go with what's aligned with your values. When I was graduating from MIT, the popular career choice for an MIT engineer was, to take an engineering role somewhere. And it was a lot of money at the time and a lot of opportunity. And I chose to, stay aligned with my value and wanting to do something that is based in technology, but brought in the business side as well. I'd say that same lesson applies today. Just because venture is very popular doesn't mean it's for everybody, doesn't mean you should do it. Every job has its pros and cons. And, that goes back to the point, if you find one that really aligns with your values, you'll find a deeper reward in pursuing that job, and the pros and cons will kind of melt away, because it's aligned.
For sure. So when you join Lightspeed, so it was like a not Lightspeed, but like formerly the other,
Respecting Greer Venture
yeah,
Partners,
totally
yeah.
that venture partner firm. So I'm curious, like it's a $1 billion firm, like that's really big compared to, many of the funds. There's a lot more $1 billion fund today, but like back then, assuming that's like one of the very few funds that are that size. So how do you kind of like stay competitive to, first of all, like getting that job? Because although maybe VC as a career was not like an obvious choice for most engineers, but I feel like to, managing $1 billion under a couple people team, it still could be a really competitive space. So how do you like master your unfair advantage to kind of like getting into that direction?
Yeah, so this was late 99, early 2000, where I started having these discussions. And, back then, like you said, it was a totally different world. It was, venture firms were not that well known. They didn't market themselves. Most people starting companies were typically, in their 30s or later, not in their 20s. And so, I just happened to meet somebody at a MIT alum event who was one of the managing partners at Weiss Peck and Greer Venture Partners.
Mhm.
And he said, "Hey, did you think about venture? Why don't we talk?" And I didn't really know much about it. MIT, I'd say, was back in those days starting to get disconnected from that whole world. So coming out to the West Coast, I was a product manager for Cisco. I still wasn't connected to that world. And so it was really not me looking for that job and me saying, how do I make myself competitive? It was really luck. And the luck was venture tends to bring people in relative to the boom that's happening of that day. And the boom happening of that day was networks being built out. The world, if you remember this world of the CLEC, these were new carriers that were being funded by effectively cheap debt, that were springing up all over the place, and they were all buying next generation equipment. And so and networks were transforming. Cisco was going through a hockey stick. And so people were looking for people who understood networking. And so I happen to have lived in that world. I happen to have built, a new business in that world. We pioneered broadband. We wrote the DOCSIS spec, which is now the spec used for how high-speed data goes over cable networks all over the world. So I happen to be at the right place at the right time. But I think that's what you're seeing today. People who are getting pulled into venture funds, did something interesting in AI is the likely role that they, spend time in. I think you're starting to see, more and more people who are in venture who spent time in venture, and people transition through a couple different firms, getting promoted along the way. That was less the case when I was there. But again, for people to make themselves competitive, you can't time, what you should be doing. And you shouldn't be doing something you're not passionate about, because you're not going to be the best at it. And so, how do you make yourself competitive? It goes back to, if you do what's aligned with your values, you're going to be the most competitive at it. You're going to be the best at it. And if that aligns with what venture is spending time on, great. And if it doesn't, go build something great. Go build something great that you're passionate about.
Totally. I'm curious. Okay, so walk us through like what do you learn at Lightspeed early on? Because right now it's a household name, and then it grew, I think, relatively really well, like since like when the beginning you guys started to now, like it's still like pretty popular. It's getting more like well known each day. And then like I guess like how do you build like a famous venture capital firm? What were like the lessons there when you were there?
Yeah, I think there's no shortcuts is the answer. It's a lot of hard work. You're only as good as your last deal. And there was a story that I was told, when I was a young associate, about Don Valentine, who was the founder of Sequoia, and he was chairman of Cisco. and he was interested in the company, and the company was not returning his calls. And so he said, hey, I'm just going to wait in the lobby. And if, told the receptionist, if the CEO happens to, be available, I'm here and I'd love to meet the CEO. And, I thought, gosh, if that's what Don Valentine does to work with and find and engage great entrepreneurs, and he's the founder of Sequoia and he's the chairman of Cisco, what do I have to do as a 24-year-old? I joined Lightspeed when I was 24, or Weisbeck and Greer when I was 24. We changed it to Lightspeed. But, it shows that there are no shortcuts. Even if you're Don Valentine, there are no shortcuts. And, how you create that culture in a venture firm that lasts generation after generation after the success, I think is something that the best venture firms do, that there's always that passion, that fire in the belly, that hunger. Because if you don't have it, then, you can't rely on past glory in venture capital. And I think that was something that, we really took to heart as we were launching Lightspeed and trying to figure out how do we become one of the top funds in the world.
Can you unpack the idea of like no shortcut? Because I feel like if today I go out there waiting in the OpenAI's lobby, they're gonna kick me out. Like, what exactly do I need to do to let's say like put my investment into a really hot company?
Yeah, it's always about alignment. It's not, yes, it's great for you to put your money into a hot company, but why is it great for them to take your money? And I think people who want to invest in the best companies have to be very clear-eyed about what value they bring that's very different. And that's something that a lot of people don't necessarily think about, is how to create that positive selection bias. And so, positive selection bias can come in many forms, but ultimately it comes down to companies believing that they would be worse off if they didn't take your money. And so changing your mindset from, hey, it's great for me to put my money in a hot company, to this is why it's going to be incredible for them to take my money, because here's what I could offer, I think is the approach that has to be taken.
Totally. Let's say like building that kind of advantage to attract the founders. What were, let's say, 3 things that you feel like would help you, or like a young version of you, to be more competitive in that space?
Well, when we were building Lightspeed, we thought about how are we going to be different. And in the early 2000s, I came up with this idea of a value add services platform. Oftentimes we'd sit around in a Monday partnership meeting saying, hey, does anybody know anybody at this company or that company? And it was an ad hoc exercise. And my idea was, hey, every Monday, we know our companies care about customers. Why don't we just go out and meet all the customers and systematically have them meet our companies? And so built, our customer introduction platform that was, ultimately, it was very unique and differentiated at that time. We pitched it to our subsequent LPs of future funds as a differentiator. Ultimately, it was copied by everybody in Sand Hill Road. But, there was a time where, we started building, and of course, Lightspeed and other good firms continued to build differentiation. But it goes back to that point that we could talk to companies and say, this is the value we can deliver that's very different from what you'll get from other venture firms, because we had something others did not have. Early on, we started thinking about the value of international expansion and how having arms, legs, investments in different regions can create synergy across our portfolio. And so I drove a lot of our international expansion, found our founding China partner, recruited our founding partner for India. And that's something that, again, we look for an avenue for differentiation for why we'll add value to portfolio companies in a way that's different than what others can do. And again, ultimately, over time, other people went international also, but I think we're very proud that, back in those days, we created something that was unique in value add services and having a very successful international investing program.
Totally. I have a couple questions there. Like, one is, there's like one part is about the career direction part, as like you later on went out to start one of your own like Stonebridge Ventures, and then there's like a new partnership right now it's Ballistic. And like, I'm curious, like, why different firms, or like using your word, like venture capital startups, and then assuming, since like you have like lead a company to a really successful exit before, after leaving Lightspeed, assuming you can also just go back to Lightspeed, right? Like, so what was the thought process there? And then number two around that line is like, how do you build a moat in these different venture firms as you are their core partner? Since like, you are a factor that's like did not change, but like there's like, what is the differentiations between them?
Yeah. So for me, I know it sounds a bit like a broken record, but this is the power of values, right? Is it becomes that North Star. And so, my journey, I saw an opportunity again to do something very impactful that had a big positive impact with pursuing this idea behind an online marketplace for real estate transactions that ultimately became 10x. And why is that doing well and doing good? It's because you could do well because real estate's a multi-trillion-dollar market. If you could pioneer the online transaction, that's a big TAM. It's a massive TAM. But, I saw that there's an opportunity to do good because ultimately for most people, real estate is the biggest investment of their lives, but it's not transparent. It's not efficient. Interests are not aligned. And that's what I knew the internet was really great at, to align interests, to make things more transparent, to make things more efficient. I said when I was building 10x, people had more confidence in buying a bread maker on Amazon than they did buying the biggest purchase of their life, which is a house. The internet has a chance to change that for many, many people, and real estate touches many, many people. So that was, again, while it seems like a very different area, was very aligned with that value. And again, Ballistic is the same. Day in, day out, we live our lives more and more online. Ballistic focuses on cybersecurity. Cybersecurity protects our ability to live our lives online. And what we've seen over the last years and even the last weeks is that our lives offline can't happen if cybersecurity doesn't work. I can't check into my room at MGM if cybersecurity isn't working. I can't go to the hospital if cybersecurity isn't working. I can't get gas if cybersecurity isn't working. And so for me, this idea of starting Ballistic with a phenomenal team of folks and focusing on this mission of cybersecurity was, yes, we could actually have a chance of building the next 50 billion market cap company. We can do well, but also we're going to do good because ultimately cyber protects our freedoms. And, the moat, is really about thinking about what is your positive selection bias that you're going to create. I mentioned what we built at Lightspeed early on. At Ballistic, we have 5 senior people who've been involved with 90 cyber companies previously that created 50 billion of value. We all have deep operating experience. We have 40 years of combined professional venture experience from great firms like Lightspeed, and my partner Ted, who ran Kleiner Perkins with John Doerr. And so we bring all our expertise to each company. So every one of our portfolio companies gets all of us to help, because each day, all of us only focus on talking to customers that matter, partners that matter, talent that matters to a cyber entrepreneur. So, we think that's a moat. We think that's positive selection bias, that we could offer something unique to the best cyber entrepreneurs with our strategy.
When you mentioned about like building up the customer profile, right? Like, so that's like a great value add. Curious, like, what is the differences between, like, let's say you reach out to those customers as a VC compared to, let's say, I'm a cybersecurity founder. I just hire like a great like sales guy. Like, what is the differences between, like, let's say my VC add a value to my company compared to if I just got like a great CRO?
Yeah, there's a couple things that put us in a unique spot to get engagement. One is, the people who lead security know that we're not looking to sell them something directly. The people who lead cybersecurity organizations, the CISO, Chief Information Security Officer, but increasingly heads of engineering and even CEOs, right, care about this. their job is to understand the future, right? And navigate their businesses based on what the future might hold. We can educate them on what's coming down the horizon and educate them not as it relates to one company, but as it relates to an industry across many, many different companies. So I think that ability to talk broadly and be a strategic thought partner, because we live and breathe what's coming down the pipe in the future of cybersecurity, and it's not tied to one product that I'm trying to sell this moment or this quarter, is a difference. We could also connect them as we learn about their needs with companies that are going to solve their problems. Even if it's not in our portfolio, if we have, somebody that we work with and they say, look, I'm really looking for this type of solution and we know about it, we're going to connect them because we want to help the community. And that's also the power of focus, right? In cybersecurity, it actually is a very, close-knit community of people trying to solve problems. And so we're there, again, not as a salesperson, but as a problem solver to work in partnership with large customers.
Totally. I love that, like, you guys can serve as like a third party to offer the education piece to these companies, as well as like kind of giving them a broader view of like what's going to happen instead of like the past. Out of like curiosity, so like, this fund has like a lot of really great partners, like you mentioned, Ted from KPCB and yourself, and like, who went through like the great fund. So like when it comes to raising funding from LPs, like how do you kind of, I guess, like position yourself in that sense to, because like I'm sure like the track record matters a lot. But like, in any circumstance, like to raise hundreds of millions of dollars is hard. So like, can you talk about like the process of the fundraising journey, like for you? Also, you probably already have your own venture firm. Like, what was the process differentiated from, if you're just raising funding as yourself, as a solo GP to, raising funding with other great like fund managers?
Yeah, well, I'd say, we're very lucky to have great LPs and a lot of great support. But I think we get that support, again, whether it was Ballistic or, Lightspeed early on, or Stonebridge, my own solo capitalist fund, because we had a clear strategy for generating positive selection bias. And I think the LPs understood that strategy, saw our ability to execute and create that positive selection bias. And so, here I think we talk about, why we offer something different to the best entrepreneurs, but also, LPs care about returns. And we have a very clear strategy for how we generate outsized returns. And that strategy is being in a sector with massive tailwinds. Fortunately or unfortunately, cybersecurity is growing like crazy. The need is becoming greater than ever. Cyber doesn't get solved, it gets fought. Second, we think a best-in-class team in this area. Third, we make high conviction investments. We don't sprinkle capital. So every investment we think has the opportunity to have high impact on the portfolio. And then as an institutional fund, we think fund sizes matter. And, a fund size in the low hundreds of millions is easier to compound than a much larger fund size. And so with those elements of our strategy, LPs, get excited about what we're doing.
Totally. I like the last point you mentioned about like, having a $300 million fund size is easier to compound than maybe like a larger fund. So you have the experience of managing, when back in Lightspeed, there was like $800 million fund, $400 million fund, $800 million fund again. So what is the strategy differently, like in terms of investing when you're managing a $400 million fund versus like an $800 million fund?
Yeah, well, I think importantly at Lightspeed, our first, our fund in 2000 actually was $1 billion fund, and we gave back 200 million. And the challenge there is it was solely focused on early stage, really predominantly US. We didn't have any partners located internationally. And early stage US at that point was harder to deploy that much capital. Now, some things have changed. One is the early stage fund you might have other geographies that you're going to invest in, not just the US. Two, companies are raising more capital these days than 23 years ago. And so, with that, and lastly, at Lightspeed, back in those early days, we said we'll let other growth investors invest in our best companies at these higher valuations. And what we realized is if you have great companies and you did the hard work to find those great companies, help those great companies, you should have more capital to double down on those companies. Mm. And so I think a lot of those lessons, have evolved in the venture industry. Now, for us, we're simpler. We focus on one sector, not many sectors. We focus on just US investments. And so, we don't need the same size fund because we're more focused in our strategy.
Yeah, for sure. So I think I really like the focus approach. In terms of focusing on one specific sector, I think one of the things that if I were like a founder in the cybersecurity space, let's say if I come and pitch you like about my company, since you're already really familiar with the space and you probably talk to my competitors too, and then maybe you already founded my competitor just without the news hitting TechCrunch or wherever yet, because of in a specific sector, is your approach investing in every company that you find interesting in this category, including people that may be like the number one and number two in the same thing, like Lyft and Uber at the same time, or like this is like not an approach? And how, I guess, like as a founder, or in the space, how would you, if they have like any concerns, like how would you kind of deal with these things?
Yeah, we don't invest in directly competitive companies. And, look, our reputation is more important than anything, right? We're not here to have a good fund one or a good fund one and fund two. We're here to, hopefully leave a legacy of a firm that has the best reputation for helping early stage cybersecurity entrepreneurs. And hopefully that outlives our useful lives. And so, reputation is everything. Integrity is everything. And so, we know that if we don't act in those ways, then what we're trying to build, A, it wouldn't be aligned with who we are, and B, we wouldn't be able to build what we hope to build. And I think, every venture firm, will have a version of, hey, you might have stealth companies, and when founders come along, hopefully they have the same approach to say, whoa, don't get into what you're doing. We can't tell you about it, but we have a stealth company. I think, integrity has to be the bedrock of every venture firm.
For sure. So like you have a really great portfolio beyond the cybersecurity space, right? Like, so you have invested in Brex, Blend, Carta, Cresta.ai, and among like just like you invest in a lot of unicorn companies. How did you encounter these deals, and like how do you get into these competitive deals?
Yeah, so deal sourcing, that's the lifeblood of venture, and you have to use all the tools, bottoms up, tops down, and middle out. I think, I was very fortunate to apprentice and build my sense of what, is a good company at a great firm at Lightspeed. And so I think that helped that, that training and mentorship from, lots of great folks over the years. And then, lastly, it goes to a positive selection bias, and something that I was very clear about, with my Stonebridge portfolio was how I was able to help companies and the tangible results that it delivered. Early stage, high profile companies like Abnormal Security, I invested in the A round. I was the one who found their chief product officer. I was the one who convinced their CRO to join. And, then entrepreneurs talk about that and say, hey, if you want a great value add investor, and turns out real value add matters, they introduce you to their friends and you create that positive selection bias. And I think at Ballistic, it's the same thing, where because of our focus, because of our expertise, because we're all for one, meaning, 5 senior partners helping every company, we offer something very different that allows us to get access to competitive deals.
For sure. I feel like venture is a numbers game from another extent. So how do you pick which company that you would focus your energy to? Because if you're recruiting everybody for every company, you will have no time to do anything else. So how do you kind of like leverage your time to pick who to help or like what to do?
Yeah, I think that's more of a strategy of, what is your investment strategy than, who do you pick to help? My view is if you commit to a company, you're getting married. You're there to help in sickness and in health, for richer or poorer. You're there to help that founder. And so to me, the right approach is not picking who to help and who's the cooler company and which child you love more. It's having an investment strategy that allows you to pace yourself so you don't get overloaded. It also involves understanding what is the high order bit to focus on. Focusing on everything is not possible. And so for each company, really being in tune with, where the most impact is to be had and how you deliver that impact, I think also is part of it.
Because of you had many years of experience as running a successful company, as well as like you joined a top VC fund when it was like a very early stage when it was at the startup phase of that VC fund. So like you had great experience. But let's say if you and I are starting another fund together, how should we go about the adding value piece to the founders?
Yeah, well, if you're starting a fund and you're not clear what value you bring, I'd argue you should start a fund, right? That's the first step, is asking the question, why does the world need another fund? And if you can't be very, very clear about why they need that fund you're starting and what you're going to bring from day one, I'd argue don't start the fund, because then you'll have adverse selection bias. You'll bias adversely, right? And the best companies will not come to you. The companies, that are struggling will come, and because you don't have a clear sense of why you should be there, because you're going to do something differently. So I think that process and that clarity has to come before the fund is started. And each team that starts a fund is going to be different. And I'd say the important thing is, people used to have this debate: do you need operating experience? Do you not need operating experience to be a great venture firm? I think any background can create a great venture capitalist who delivers something. But that said, there's no generic answer I could give. Say, oh, if there's two people getting together, what should they focus on? What I can tell you is, if that's not clear to the two people starting it up front in a very kind of intellectually honest way, then you shouldn't start the fund, because the world definitely does not need another venture fund.
Yeah, totally. I think like one of the biggest value add is nowadays to a lot of like, let's say the solo GP or like the creator turned fund managers is, let's say, some cloud, and then as well as like a great network, right? Basically every VC has a decent network. And I think the value add is getting a bit more vague, because everyone can claim that, as you know, I know X, Y, and Z, and then, I'm best friends with XYZ founders. How do you make the founder vouch for you when you are helping the founders? At what point did the snowball start begin making sense for you? Let's say after you help the abnormal security team, after you help one company, did it snowball into the other 50 of your investment, or after you help, let's say 10 company, and then like it began snowball? How do you kind of build that kind of momentum as a VC?
Yeah. So on the first question, these vague, I've got a good network, I know a lot of people, I've got a bunch of followers. This goes back to that point of, if you're starting a venture firm, you have to be very intellectually honest and ask yourself the question, so what? Everybody has a network. Everybody knows a lot of people. What does that mean in terms of tangible differentiation? And, what I found was, that I was able to deliver, tangible results, that customers who delivered purchase orders, fantastic talent who accepted a job that didn't come from any other source except me. And also, what I found personally was my unique journey, having spent, 10 years in venture and 10 years in operating. I could really be a consigliere to a CEO and say, hey, having sat in your seat, here's how I think about things. Your investors sitting on your board, here's how they're going to think about things. And here's how you reconcile those two things. And so having the experience of both journeys, the investor and the person running a company, I think really helped me work with first-time founders on how they navigate, that role and the different stakeholders they have. And so from a snowball perspective, I think it starts from company one, right? Company one, you're either delivering that tangible value or not. And, company one then becomes, should become your greatest cheerleader when you start to look at company 2 and 3. And so, all snowballs, start at the beginning, right?
Mhm.
And so to me, it starts at company 1. And again, it's even before company 1, it starts with a very intellectually honest approach and view on what are you going to do that's going to be impactful that others aren't. What is that positive selection bias going to be? And if you tell yourself, it's this great network, to your point, that's too generic. You have to force yourself to really think more critically, because everybody has quote unquote a great network. So what?
Yeah, for sure. I think like I really like what you said about like, the first like snowball start from like day one, start from like the first company you help with. Abnormal Security is a successful company. What if like, your first like 10 investment or something like, or like first couple investment that were not like a good project. Like, yeah, you did help the CEOs, but like it did not become like a perfect logo on your venture website. Like, what if that happened, and how do you navigate a situation like that?
Yeah, that's what I say. I was very fortunate to have a great, apprenticeship starting, again, as a 24-year-old
Mhm.
at a firm that, ultimately had kind of 30 years of history before that with different things in Weispeck and Greer before we spun out. And so, I think that's an important step, right? Is okay, if you're going to be a venture investor, how do you develop your sense of not in a bull market where everything's going up and to the right every day, but in a normal environment of what makes a great team, a great company, a great opportunity. And then if you have that, you're going to have things that work and don't work, and there's going to be companies that you work hard for that don't work out. But that's venture capital. That's part of it. And so now, if your first 10 investments you worked really hard for and none of them work out, well, then you have to take a step back and say, well, is there something I missed in terms of how I make investment decisions? And that's, one of the hard parts as a solo capitalist for people starting those funds is, having a debate with yourself is hard, right?
Mhm.
Part of the value of having partners is everybody sees things a little bit differently. You challenge each other, you push each other. And so for people who haven't been mentored at a place, they haven't, they don't have partners, you have to ask that question, how am I really going to push myself on investments and the investment strategy and the thesis, and not just drink Kool-Aid? Who is going to be my devil's advocate? And that's hard to do when you're a solo capitalist.
For sure. Among all your couple questions, one is like, you mentioned a couple times about apprenticeship, right? Like, so basically you were at a great firm, Lightspeed, and then you have met great mentor who is on your personal board of advisors. And how do you kind of like maintain that kind of like relationship going forward in your career? And number two is about like building a great sense of investing. What were the lessons that you've learned from your mentor in that category and that you have implemented into your own investing thesis?
On the personal board of advisors, I actually have a very different view on that. And look, I'm not saying it's the right view, but my view is I believe, you look at everybody as a potential mentor, and you look at, everybody out there has something that they're so exceptional at. And those people might not be older than you, they might not be your boss, they might be people who work for you, right? And so my view in life was always, as you interact with people, try to see what different people are exceptional at and learn from that. Versus limiting myself to, a couple stars. And, by the way, stars are human, right? They do things well, they do things poorly. And so I didn't want to limit myself. And so, that's, my take. I don't have a board. I have, everybody I interact with, I really try to understand, do they do something exceptional and can I learn from it? In terms of making great investments, I think the devil's in the details, right? There's always big markets, great teams, differentiated technology, blah, 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 blah. That's motherhood and apple pie. That's totally meaningless. And so, if you're going to get into, a particular company in a particular area with particular market dynamics, with a particular team, right? It's really kind of a lot of the details about, okay, what creates a thesis for why something can be big. And I think, ultimately, one, piece of advice when you're doing early stage investing is there's always, issues with every company at the early stage. That's why it's risky, right? And that's why the return opportunity is high. And so, as opposed to thinking about all the ways something can go wrong, really thinking about, is there a thesis around why it can be big? And big, is not, $500 million. It's, can this be a large independent public company? And what is the thesis behind why it can be that? And, ultimately, there are going to be issues. There are going to be things that are negative, but, every company has that. The bigger issue is if you invest in a company that can never be big, then your risk reward is off as a venture capitalist. And so if all your shots on goal are things that have a chance to be large standalone public companies, then if one of them hits, right, you're not going to be perfect. You'll be far from perfect. But if one of them hits, then your investing model actually works. If you try to be conservative and say, oh, I'm going to take less risk, but it can't be as big, that's actually a false logic, because every company, even small companies, can go out of business and lose all your money. But if something can lose all your money and never be big, you've actually taken more risk, not less. So
for sure,
that's kind of one, way of thinking.
I like what you just said about the taking risk part. I recently just chatted with another investor. They kind of hold a different view, as they wanted to be really hands-on on helping particular portfolio companies. Maybe because of the sector were very different. That was a 2C investor. You guys were more 2B focused. And I don't know if that plays any kind of differentiations, because their thesis was essentially being really hands-on helping company and then de-risk in a way to, because they are so plugged into the company. It was like really refreshing to hear your sense of taking risk. If you don't take enough risk, it's more risky than taking a lot of risk.
And by the way, I'd also say, we, are very hands-on in the sense of adding value. But since all of us have run companies before, we understand the line between adding value and meddling. And so that's an important distinction, right? People who are running companies want investors who are hands-on in a way that adds value and doesn't meddle. I think, that notion of having walked in the entrepreneur's shoes has made us very attuned to, when I say add value, I think about hands-on, but hands-on can also mean meddling. And that's why I don't like to necessarily use that word. We try to avoid the latter and really focus on, the helping part.
Totally. Can you walk us through any of one particular deal, whether it's like Brex, Blend, Carta, Cresta.ai or Abnormal Security. How do you encounter this deal? And then how do you decided to pull the trigger to invest in it? And what were another company that is there a competitor? We don't have to name names. Why do you see that company was better than the other company?
Yeah, we could take Abnormal as an example. As I mentioned, deal sourcing, you have to use, every tool at your disposal to find investments. But, really what I saw was, when I look at investments, you're looking at these large TAMs. And, email security had produced very valuable companies. There's a company called Proofpoint that was ultimately bought for 12 billion. And what we saw was two shifts that were happening in the market. One was the change in attack vector from bulk attacks on email, bulk email phishing, to more specific email attacks called spear phishing. And fundamentally, when Proofpoint would do their work and look at traditional bulk attacks, they would scan for malicious links, malicious attachments, and that was the way you protected that surface. Well, if somebody had been spear phished and their email was compromised, and let's say, I compromised the CFO's email and I'm an attacker, now I could send an email to accounts payable from the CFO's account saying, send out this payment. There is no malicious link. There is no malicious attachment. It's an email from the person's account. It's a totally different architecture required to solve that new threat vector. And there was an idea that this new architecture back then of AI could actually be quite effective in addressing this new threat vector that was just fundamentally different from what the incumbent was designed. So, the themes that, kind of stand out were, the email security market was massive, that this was fundamentally an architectural difference, not a feature advantage that the company was going after. And that architectural difference would be very, very hard for the incumbent to move to quickly. Also, that ultimately the area where the incumbent in was getting increasingly commoditized and can become a feature of this new architecture, especially as you move to the cloud. And so there was an architectural transition, not just on the product side, but on the customer side in the move to cloud and SaaS. And so with all these vectors of change, combined with what I thought was a phenomenal founding team, with the two founders, saw that this would be a very compelling investment. And so, but, there was a lot of ifs, right? It was still, how big would this attack vector be? Would I be wrong about the architectural advantage? But that was the thesis. That was the investment thesis on why it could be big. And yeah, there were things that, still had to be figured out, but that's part of the risk you take in a Series A. But the clarity around why it could be big because of the team, the approach, and the market was very clear in my mind.
Is there another company in that exact same space that you saw, like let's say they're a competitor, you have like came across and then you decided to go with them? Like
Yeah,
when
there were companies, in particular one funded by other well-known VCs. And, again, what I saw was, this company, Abnormal, had taken a cloud native approach. The other company had taken a more traditional approach to try to solve the new problem.
Mm-hmm.
And the bet was there was going to be an opportunity where the world would no longer accept that traditional approach. Mm-hmm. And so even though they were funded by, well-known VCs, I believe that fundamentally their architecture put them in a box that would not make them viable. And so that was also part of the investment thesis.
How do you educate yourself into different particular sectors? Because before the current fund, the current fund is focused on one thing, like cybersecurity or security in general. But previously in your other fund, you were making a lot of bets in different sectors. How do you quickly educate yourself to become an expert in that space?
Well, it wasn't necessarily, quick. I had, I obviously spent 6 years at MIT studying computer science and electrical engineering. I spent time building a business at Cisco in the, networking world. I spent 11 years at Lightspeed looking at, B2B models and businesses from infrastructure to applications. And then, companies like Brex, I was an early pioneer in building a business in a regulated area. And, I had this thesis that the low-hanging fruit in the internet was picked. And now the next fruit up on the tree were these massive trillion-dollar TAMs, but they were regulated, real estate being one of them. We had over 100 licenses required to do the work that 10xauction.com did. And so, so part of it, there was a thesis around, regulated areas like financial services moving online. And then, what I heard from the founders and their approach, and as I dug and as I did due diligence, it really resonated. So on one hand, it started with, a lot of time and experience coming into doing what I do. But then the other part is you have to do your work. And again, no shortcuts, right? Most companies can seem great at first blush. And then, doing the hard work of, talking to the market, the customers, competitors, executives, to really form an investment thesis, test that thesis, and again, do it in a very intellectually honest way. And, people who are, went through an engineering program or a math program or a science program know that intellectual honesty gets beaten into you. You don't presume to know anything. You either know it or you don't know it. And if you don't know it, you have to figure out how to get to understanding it. And so, that kind of process of learning about areas and not just being cavalier and saying, I know it, that's kind of, it at least was beaten into me through, my education.
For sure. I totally understand that because of you had like a great education as well as background in the engineering space as well as the venture space. So like maybe there's a lot of pattern recognition when you encounter these deals. As saying like because of let's say as a younger person, maybe I also have a lot of access to like these founders from like a social perspective. Like, after let's say you met blah 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 founder at a party, but like how do you quickly do due diligence about this company to say putting money in? Because of I would say like, even if I encounter a particular company that eventually become big, but when it was at a very early stage, it's really, really hard to tell what are the criteria that you should be looking for, right? Like, so beside like a numbers game approach, number one is like, what are characteristics that you would use as your benchmark to evaluate each company? And then how deep of the due diligence you have to go through to decide to put your money in or not?
Yeah, I think if you're a young founder, your advantage is your social, your IRL social network. Then you have to understand that that's your top of funnel. That's not your bottom of funnel. The top of funnel can come through many sources. You meet somebody at a party, you meet somebody through a business network. I've met entrepreneurs through parties in the city, right? And have to go through the same process, whether I meet somebody at a party in the city or I meet somebody in some other context. And this goes back to your point where if you're just a total generalist and you haven't spent time in any sector, then it's going to be a little harder for you, right? People would say, well, I'm just going to follow great entrepreneurs. Well, a lot of times great entrepreneurs aren't great entrepreneurs until they become great entrepreneurs,
Mm-hmm.
right?
Mm-hmm.
So, I think it helps a lot if you pick an area and develop a thesis, develop a prepared mind, and you're not just doing due diligence on an opportunity when an opportunity comes up,
Mm-hmm.
but you're diligencing that area all the time, thinking about what's available, what makes sense, what are the problems, what's broken, what do people complain about. And then when you see something that starts fitting into the problems you hear about, it's not like you're trying to figure it out from square one. You have a prepared mind. And so what I recommend, for, young folks who are starting their journey is, pick a large area that has an interesting tailwind, has a chance to produce large public companies, intersects with a positive selection bias strategy of, again, why people will be compelled to take your money because of what you're going to deliver for them in that area. And then you're always learning about that area. And then when you see a company, you'll be prepared. If you're just learning about everything from scratch across every different area, you're doing that's very, very hard.
For sure. If I were you, I could have just started in property tech as a sector, right? As an investor, if I were starting a new fund or something, since you have spent so many years in there as an operator, as well as you have this amazing investing background. How did you pick cybersecurity in general? And many of the younger investors are emphasizing on the follow-on run. People were afraid of making bets on like things that they may think it's interesting, but because of the venture community typically will pick on a particular company, there is a one clear winner. So people will be really focusing on who else is investing, right? How do you develop a sense for yourself to having the conviction to go in with one company over another?
Yeah. So, first question, why not a prop tech fund versus cyber? So Stonebridge, I invested a lot in prop tech. And so I did that. And one of the things that I found with prop tech is while there are areas that are pure technology, there was a lot of innovation that it was not clear that it really would be valued as a technology company, versus a property company or a financial services company that uses tech. And so for me, while I feel fortunate to be involved in some great companies in that area, I think we built something great at auction.com and 10x, the breadth of opportunities where you could say this is fully tech, not prop with tech or fin that's using tech. And the adoption cycles, because people in the real estate community are just not as mature in adopting new technology. It's changing, but still not as mature in adopting new technology from startups as other areas. I thought, okay, this is going to be one area, but I don't think it was going to be as big an area, as opposed to cybersecurity, where every company is truly a technology company. Every company, you truly have a chance to do good and do well. You're protecting our ability to live our lives online and offline. So again, aligned there. And the opportunity set is becoming broader, not, feeling like it was narrow. And so with that, to me, it felt like a dedicated cyber fund would be absolutely compelling. And, again, combined with a team of folks that got together to do this, felt absolutely compelling.
For sure. Okay, so I have one last real question and 1 minute fire round. So one is you have recruited the former CEO of Starbucks to join your previous company's board. How do you build a network like that? And then what was the pitch like, or what was the conversation like to convince someone like this to join your board?
Yeah, so I used a search firm, who specialized in recruiting great board members. And the pitch was, very simple. Transactional real estate market's a multi-trillion-dollar market, and we're pioneering taking that market online. And so this goes back to if you're, an entrepreneur or a VC, right? It's, can you find things that are very, very large TAMs? And again, that was why, one of the reasons why I was inspired to go from Lightspeed to building an online marketplace for real estate was, there's a multi-trillion-dollar transactional TAM in real estate, in addition to, it being something, very inefficient in the traditional way that can really be changed for the good of people, the good of the principals involved in the transaction. So I think he saw that opportunity as well to be the pioneer of moving a multi-trillion-dollar piece of the economy from offline to online. Those don't come up that often, and it was inspiring for me to go after that. It was inspiring for him.
Yeah, for sure. That was definitely really cool. So we are the 1 minute fire round for you. So number one is, what's your favorite book?
That's a good question. I really like Thinking Fast, Thinking Slow.
Thinking fast and
Um,
slow. Yeah.
yeah, about really thinking about decision making, because obviously that's what we do all day, every day, is make decisions with imperfect information.
For sure. Who would you invite to your dinner party?
I'm pretty boring. I like having dinner with my family. So I would invite my wife and kids.
That's a great answer. I hope you can achieve that today. So, who made the biggest impact in your career?
Yeah, look, the person who hired me into this, first job out of school, as a product manager as opposed to an engineer, betting on somebody who was an engineer, not just looking for a business school person, had a big impact. Chris Sheppy, Barry Eggers, Ravi Matre, who made a bet on me, as a 24-year-old. Again, without an MBA, everybody in venture seems to have a Stanford MBA. I didn't. I didn't have any MBA. They obviously had a big impact, and so there's a lot of folks along the way that the folks at the offline business that was private equity owned, that I said, hey, here's a vision. Do you want to go on this journey with me to build the first online marketplace? They have a big impact, and Ted Schlein is the one who really had the vision for Ballistic, a dedicated cyber-focused fund. I think he's on that list also, because I think we're building something special.
Wow, that's a really great list. Where can we find you outside of work?
I'm on the slow path of learning jujitsu. So,
Oh, wow.
Where I can, I try and get in mat time. It's not always easy, but that's my kind of thing that's fun outside of work and family. Obviously, I have 3 young daughters, and so you could find me on a lot of soccer fields and other sporting venues, the swimming pool and the soccer fields. But outside of work and family, that's been my fun thing to do.
I mean, why jujitsu?
Yeah, I think it's like kind of physical chess. I feel like, in addition to getting a great workout, it's, you're thinking very strategically, you're using your mind. And so I really found joy in that combination of getting a workout, but, problem solving while you're getting a workout. So it just resonates with me.
Yeah, wow. I like the physical chest aspect. So last question. What's your content diet look like?
Content diet, email.
Email. That's a great answer.
Yeah, that's as a VC, obviously outside of email, we're just meeting entrepreneurs and customers and people in our industry all the time. And so it's learning a lot in the industry, and then trying to find great books that people recommend, like Thinking Fast, Thinking Slow. There's kind of a corollary to that called Thinking in Bets. One of our advisors, Nicole Perlroth, wrote a great book called This Is How They Tell Me the World Ends, which is a fascinating look into cybersecurity. So great kind of books that people recommend, and then just always learning from the entrepreneurs and practitioners in our space.
Yeah, wow. I like the first answer, which is email, the best, because that's the honest answer. I love that. Thank you so much, Jake, for coming on the show today. Definitely learned a lot, and it's a great conversation. Thank you so much.
Yeah, thanks for having me. Great talking.
Thanks for tuning into Smart Venture Podcast. If you learned something from the episode or even just mildly tolerated me, please subscribe and leave a 5-star rating. I promise I will keep bringing you more successful, insightful interviews and insider tips about startups. Remember, sharing is caring. So tell your friends to listen too, or enemies, I won't judge. Until next time, keep venturing smartly.